I guess there's a fair chance of another official cash rate increase in September, particularly given if this Iran situation lingers the way it is now.
Kia ora, and welcome to the New Zealand Property Market Podcast, brought to you by Cotality for the 13th of July 2026. I'm Head of Research Nick Goodall, and today I'm joined, as per usual, by Chief Economist Kelvin Davidson. Kelvin, manu atia a Matariki. We'll check in on how you spent your long Matariki weekend later, but first, we got our June buyer classification data late last week. So with like 6 months down in the calendar year, I thought it was a good time to delve into that buyer activity for a little bit. Have you had a chance to look at some of the data there? Do you want to kick us off? And then I've got a few stats and numbers and a little bit of insight and deeper dive to go into.
Yeah. There's a few numbers down the run sheet, isn't there? So, but no, I mean, at a headline level, it's. I mean, first-time buyer strength, and we say it every month. They just keep doing their thing. It's so in the month of June alone, first-time buyer market share 28.4%, which was very, very close to a record high for a single month. I think there's only 1 month, kind of maybe September, October last year, where it's higher. So pretty much a record high on that monthly number. The number of deals as well is still pretty strong. So it's not just a market share thing, it's actually number of deals as well. And if you look across the quarter as a whole, across Q2, 28.3% is a record high. So when you add up April, May and June, we've got a record high market share. And these figures go back to 2005. So it's just, I mean, it's great news. You know, everyone loves a first-home buyer, so they're just doing more of the same, and it's reflecting all those same things: low deposit loans, access to KiwiSaver. You know, obviously benefiting from lower house prices, cheaper interest rates than there were, say, a couple of years ago. So all of those things are helping first-home buyers in, and it's easy to get sort of complacent, but they just keep doing their thing. So really good news there. Bit of a bounce back for mortgage multiple property owners in the month of June. They had a really quiet May. They were down to, I think it's 21.5% in May, bounced back to 23.3 in June. So, a bit of you'd maybe say that the May weakness was a wee bit of a blip, perhaps. But again, when you sort of smooth these things out and look across a quarterly figure, you can still see there's a bit of a downwards trend there. They've had 2 falls on a quarterly basis in a row. So sort of a cyclical peak, or whatever you want to call it, in the final quarter of last year, and have been sliding lower this year in terms of market share. So, a wee bit of a bounce back in June, but on that bigger picture, I think there is just a bit of caution coming through from those mortgaged investors, and fits with what we've been talking about for a while. We've got flat rents, we've got high costs. People starting to question long-run capital growth assumptions, but also the election. There's that possible tax changes around property if we saw a change of government. So there's supports for investors, but I think probably what we're seeing in the data now is just people pulling back. They're just saying, okay, happy with where things sit right now, wait and see how the election plays out, and then possibly make a return to the market after that, potentially, depending on how things go. So first-home buyer strength, those mortgaged MPOs a little bit quieter, and movers, so the relocating owner-occupiers, down at even less than 24% in market share across the second quarter. So, pretty quiet out there for movers. Those relocating owner-occupiers really are, I guess, there's a thing as we'll talk about, when you break it down further, there are some groups that are holding up perhaps a little bit better than what you'd think, but in general, movers are pretty quiet, and I guess they're just thinking, things are uncertain. If I don't need to move, why would I? I'll just kind of stay where I am and sort of ride out this period of uncertainty. So I guess, movers not moving as much as perhaps they ordinarily would, and it's a low number. When you see it on a chart, they're pretty much down to GFC levels again. So even though you could probably argue we're in a more stable environment than what we were back then, we're still back down to those kind of levels for movers market share. So they're still pretty quiet. So it's, in some ways it's more of the same, but there are always those little subtle changes from month to month and quarter to quarter.
Yeah, and certainly, like I say, kind of record levels, to some degree for all of them. whether it's over the whole history or in the last, almost 20 years in the movers case back to the global financial crisis. So yeah, certainly some intriguing figures there, but I wanted to delve into it in a little bit more detail, being the numbers guy, I suppose. And so for our multiple property owners, we do break them down into how many properties they own. And interestingly, we group these into, multiple property owners with two, which are those that have two properties after their most recent purchase. So essentially it looks like one investment property. Could be a batch, I suppose, but essentially someone with two properties after the most recent purchase, 3 to 4. So it definitely looks like they've got at least one investment property, maybe on top of a batch and their own home. And then 5 to 9. So we're getting up to, building a substantial portfolio there, and then 10 plus. So pretty significant property investors at that end. But for MPO2s, they're actually holding on okay. They were definitely a strong driver of the resurgence we'd seen since sort of mid-2024, when they sort of dropped to a relatively low level. And they're sort of, consistently around about that 8% mark for the last few quarters, which is the largest individual group, I suppose, within the multiple property owners, making up that 23% that you spoke about for all multiple property owners. So 8% of that 23. So, basically roughly a third, I suppose, pretty small mum and dad investors, you'd call them. Mum and dad investors might still fit in the 3 to 4 category. And they were also part of that strong resurgence, but they are now trending down. So while MPO2 is kind of holding sideways, the MPO4s were sort of trending down slightly, down to 5.3% in Q2, slightly down on where they'd kind of peaked at the end of last year. But it's the larger ones that we've seen holding back more from the market. 5 to 9s never really recovered after that dip since the peak of the market at the end of 2021, start of 2022. They only made up 2.6% of sales in Q2. And as I say, when you see this on a chart, you can just see that, they dip away from the peak of the market when all property investors were absolutely filling their boots, and, it looked like every property investment or property purchase couldn't go wrong. And, low, cheap money, of course, low interest rates, cheap money meant that, everyone was trying to buy any property they could get. They really haven't recovered since that fall away off the back of that peak. Whereas MPO 10 plus, we're sort of holding up near relative highs too, actually. They've been pretty active over the last few years at 3.5%. So again, small-ish proportion of sales each quarter, but they did noticeably, really noticeably on the chart, drop to 2.3% in Q2. So, that's essentially a third of all their activity dropped out of the market. So, I do wonder, that is the group that absolutely would be most affected by a more comprehensive capital gains tax. Their cash flow would be significantly affected if they can't write off their interest costs and their tax returns every year. So, it does make me wonder about the nervousness about the election and potential change in government, which could see some form of tax change. Who knows, right? Might even happen this time around, but their nervousness that we hear about, it looks like the action backs that up. Now, this is just people buying property. Their buying activity has reduced. We haven't flipped it round to look at sales, who's actually selling property right now, and whether they're actually divesting out of the market, but certainly buying less property as well. And as you sort of do, tie it back to these first home buyers, making the most of these buyers not as active in the market. So, yeah, you could say that's certainly a positive, but we also do want to stress that you do need property investors to be out there. We do need rental properties. We've got, I know you didn't touch on it there, but migration isn't quite as strong as it has been in the past, but that is another reason for less rental demand. But we do need rental properties for new people to market, new people moving to the country, students, people that, want to be, moving around a little bit, don't need that security of tenure so much. So we do need to see a healthy investor market. But as you say, when the flip side is the first time buyers doing well, it sounds like a pretty good news story. It's just about getting that balance somewhere along the right lines anyway. Anything on the MPOs before I just delve into some of that mover data you touched on earlier?
I suppose just probably a question for a mortgage advisor or somebody who's really close to the ground on this one, but I do just wonder if, it's maybe the MPO2 is the kind of new investor, someone who's tapping into some equity in their own house and, using that to fund the sort of theoretical deposit on the next property, maybe it's their first rental. Maybe they're not hitting up against the lending rules, for example. You're probably not necessarily hitting LVRs, kind of, not really stretched on debt, that they might be blocked out by DTIs or serviceability testing, that sort of stuff. You kind of wonder if they're taking along because they're kind of just fitting under the rules. Maybe once you get up to, maybe it's your second rental, maybe it's your third rental, maybe that's where the credit rules are sort of kicking in from a bank serviceability testing level. We know in aggregate the debt to income ratio restrictions, for example, aren't doing much, but maybe for some people they are actually a consideration. And if it's not theoretically the DTIs, it might be the serviceability testing, which is sort of two sides of the same coin, or LVRs as well. If you maybe already use the equity in your own house, you're like, well, where do I get the next deposit from? Could be starting to struggle on that once you get up to 2 or 3 rental properties. I don't know that for sure, but and especially once you get up to the 8 or 9 or 10 rentals, where you could easily imagine those kicking in as well. So I don't know where that threshold is. It'd probably potentially be a question for an advisor or something like that. But I do just wonder, once you get beyond MPO2 and you get into that slightly bigger category, that's where some of those rules might be kicking in. So if that's true, then it would sort of stand to reason that maybe their market share might be tailing off as they move up that ladder a little bit, and serviceability rules kick in, DTIs kick in. So could be something. I'm sure there's other considerations as well, but yeah, that could be a factor.
No, that's a great point. And I think we've talked about, we know debt to income restrictions are likely to impact those larger investors. Yet they're not quite, having a major impact on the market right now, but maybe for some of them they would be. And yeah, like your point about those serviceability test rates and, loan to value ratio rules, like these things definitely make it tougher to get more debt as fast as you could in the past. Especially if you can't replace that with income from a DTI perspective. So, great point. I'd love to hear from anyone that can add a little more detail there and how some of the calculations might be playing out. Are you getting interest from these people, but then they're not flowing through to having available credit, or are they just not even talking to you because they're so nervous that they don't want to be buying into a market where they're not sure about, like, say, what that future holds? So it's a great question for the listener. Just delving into those movers then, as you sort of touched on, I wanted to look into what's happening with, we can classify these guys by basically the price they're paying for the new property that they're moving into compared to the property they've sold and moved out of. So we classify them into upgraders, where the increase in value is at least 10% more, downgraders if they're downgrading to a property worth 10% less than the property beforehand. We also look where people might be moving areas, so they're moving from, say, in Auckland to a Tauranga, and the classic case of everyone talking about people retiring in the likes of the Bay of Plenty and moving out of the big city. So we do look at those kind of as the major groups, and then those that are moving sideways might be moving to, a similarly priced home, but it's in a differently located area within the same city. That might be for schooling reasons or job reasons or whatever it might be. So those are kind of the 4 major groups we look at. For the upgraders, I suppose the big thing that jumped out at me was that they're actually holding up pretty well. Their share of sales is actually still, much higher than the other groups in terms of its proportion of all movers that are upsizing. So, maybe a bit of a surprise. But, I think back to what was the article a few weeks ago that you put out, looking at that upgrade gap has narrowed. So people trying to move from a 3 to a 4 bedroom house has narrowed. So it's not the worst time. And so maybe when we talk about movers being nervous, maybe it's not all job security or all about, the concern around, can I sell the other house, my old house? Maybe that's not as much of a problem as we had previously speculated. But because we've seen this reduction, so the other thing that jumps out is the number of people that are moving to a new area is continuing to fall away. And that seems to be the driver of that decline in overall movers. So people that are typically moving to a new area to reset themselves up, and you can probably get a bit of a bigger house if you're moving from the larger centres to those smaller areas. There's less of that happening, and so I wonder if that's a bigger decision, right? That's a bigger move when you're moving whole cities, and maybe it is the economic side of things. And how do you secure a job? Do you move and then secure a job? Are you securing a job and then moving? Do you rent for a little bit? There's going to be lots of considerations there, right? But that group's certainly down on where it previously was. And so it just makes me wonder about, the nervousness around upgrading your home and taking a little bit of extra debt doesn't seem to be as bad, but certainly the big decision to reset up foundations on a whole new area is a much bigger stretch for people. And so it's that type of activity that has reduced a lot more. So I think there's probably worthwhile us ensuring that we keep that division and that conversation, because upgraders don't seem to be too worried. Downsizers sort of holding on-ish. They're not quite as strong as the upgraders. So again, whether that's, typically we're going to talk about some generalizations here, but I suppose that's typically what we'd talk about as a baby boomer that might be looking to retire. They've got a large home. They're moving to a smaller property, less maintenance, worth loss, free up some capital. That is, it's okay. Sort of tracking sideways, but it's not exactly, holding up as well as the upsizers are. So maybe again, there's just some people waiting, and maybe they want to see the property value of their old house increase a little bit more. Who knows what's going on there? But yeah, certainly they're doing okay, but not really strong. So yeah, there's a couple of interesting trends I think happening within that data. I'm sure over the next few weeks we'll put out a few extra analysis or articles on this, and you better see the charts yourself, maybe in some presentations and things. But yeah, certainly hard to talk about through an audio format, but you get the visuals and I think you can see these trends for yourself. But yeah, I think there's some good detail in there. Really good to hone into what's going on beneath the surface of some of these buyer activity charts, and give us a bit more insight to what's happening and what might be going on there. But yeah, any other thoughts on the movers, Kelvin? Otherwise, we can sort of take a little look at some of the economic and external data that was out last week.
Yeah, I'm cautious of putting too much weight on this, but I'm starting to hear more about reverse mortgages, for example, and so someone who might ordinarily have wanted to free up some cash by selling their 4-bedroom house and downsizing to a 3-bedroom house or a townhouse or whatever, maybe now they take the option of reverse mortgage, and these are a long bow to make that correlation there, or to make that a causative thing. But I just hear a little bit more about reverse mortgages now. There's a few things on LinkedIn, and a few seminars I've seen, so maybe that's part of it, that instead of downsizing, and I know you say that the numbers are still decent, hasn't been a blowout, but maybe some people out there who otherwise would have downsized are now staying where they are, and freeing up some equity through basically a new loan. So that could be going on. And also, I suppose that this is getting a wee bit off topic, but it plays into sort of retirement village type stuff as well. I do hear occasionally that some of those retirement village operators aren't getting the next people in, I suppose, and those things might be sort of correlated, that people can free up some equity by taking out a reverse mortgage. They might not need to go into that retirement village yet. They can stay where they are. So maybe there's a sort of story underneath the surface there. Hard to necessarily say all of that's strongly related to each other, but yeah, could be part of it.
No, I think it's a good angle to look at as well, right? Like there are options out there for people. It's not just the old classic of, you get older, the house is too much maintenance, you downsize and move to a smaller house. Like, I'm sure that was, a really common thing over the last few decades, but there are options out there, and there's lots of consideration for what those older generation do with their property. Do they, pass it on to their family? Is one of their kids going to take it on? Are they going to use it as a rental and need that income while they go and live somewhere else? And are they renting? Are they going into a retirement home? There's so many options here, right? And that's why, our data, being property level data, only tells us so much of the story. And we do get lots of other insights from talking to people or looking at demographic data, and that's where dealing with other organisations that have personal information and trying to marry all that up also gives us a bit more insight as to what else might be going on beneath the surface there. Yeah, so it's a good extra layer of information to bring in as that potential for reverse mortgages. What's going on there? I don't know how popular they are, but as you said, you certainly hear more about them now than you ever have. So there certainly must be not just being talked about, but being taken on board by people as well. So I think it's another good addition to the conversation. All good, mate. Well, let's move on to the external data. The one I sort of want to touch on before we do residual official cash rate monetary policy review roundup is just the lending data that came from the Reserve Bank last week. And this is the stuff talking about the data talking about how long people are fixing for when their mortgage comes up for renewal. Looks like there's some sort of consistency coming through with the data of the last few months. Kelvin, is that what you'd say there? Do you want to just run us through some of the high level insights you took from taking that Reserve Bank data?
Yep. So this is yet another cut of the May monthly lending figures that the Reserve Bank puts out. They release a series of different cuts of the figures, and they look at DTIs and LVRs. This is the split by loan term chosen. Now, it's only for new lending. So it doesn't look at what people do when they reprice from a 1 year
Cool.
fix onto a new 1 year fix. It's not looking at that, although I suspect the behaviour is pretty similar. But it is, so it's only new lending. And so, yeah, for the 6 month in a row in May, it was about 50% or more of new loans taken out in May were fixed for longer than 12 months. So we've after a long period where hardly anyone fixed for beyond 12 months. There was a sharp sort of step shift, I guess you'd call it, in November, December last year. And pretty much since then, it's been stuck at sort of 50-55% of people are fixing beyond 12 months. So it's become a really popular option for people. It makes sense when the sort of outlook for interest rates is upwards. Might not be sharp or anything, but probably trending higher over the medium term. Of course, you'd want to lock in and effectively take out some insurance against the risk of even higher interest rates later. So not saying that's guaranteed to happen, but it's what most people are thinking now. So you can definitely see why people would be fixing for longer to try and avoid that. So the 2 year term itself is the most popular. About 31% of new loans in May were fixed for 2 years. There's a wee bit of focus on the 3 year rate, wee bit of focus on the 18-month rate, but it's pretty much 2 years is that most popular term. The 1 year fix itself hasn't fallen out completely. There's still sort of about 20% of people take out a 1 year fix, but there has been that shift to going longer than 1 year, that with that 2 year term being the most popular. So and 20% for 1 year fixes is quite low compared to where it has been in the past. So yeah, there's definitely been a shift longer. People trying to get their certainty, a wee bit of insurance against future interest rate increases. And yeah, the 2 year term's the sweet spot right now.
Yeah, no, okay. I mean, it's interesting, right? And I think my chat with Jim and Scott Davidson a few weeks ago, mortgage advisor for loan market in Whangarei, she sort of talked about there's kind of three typical strategies people are taking, and I think that data probably just backs that up as well. That 1 year, yes, 20% is low for people that were taking 1 year, but there's still a decent number of people that are taking that 1 year rate as well, and there's good reason for that, right? That flexibility. Not sure where things are going to be in a year's time. Are the interest rates going to be that much higher? Maybe not. So it's not a massive risk. But yeah, good chat with her about the sort of options that people seem to be taking and the type of people that take each one. So yeah, worthwhile listening to that one, which is a few weeks ago now, in terms of some interest rate and fixed rate strategies. But yeah, I think it's a good one to track anyway. Okay, and then just on the, I suppose, rounding up of the official cash rate review, and other commentators' thoughts. I mean, the first thing that jumps to my mind probably is the fact that, obviously the Iran-US peace deal had kind of looked pretty strong last week when this was all happening. Since then, we've sort of seen the Strait of Hormuz be shut down again, and that peace deal look like it's broken down. Now, obviously, that's going to have some influence over the global economy and interest rates and inflation and supply chains and everything. So it needs to be paid attention to. And as with everything, it was one of those ones that was just mass uncertainty, which was acknowledged by the committee themselves. I don't know if you've got any sort of quick takes on that one. The other things that I just wanted to talk about was, in terms of setting things up, we talked a little bit about, what the next decision will be in, was it August, late August?
Early September, maybe.
Early September. But even looking maybe beyond that as well, the sort of conversation about what are we expecting by the end of the year, maybe trying to just pre-brief people on that. Any final look at what happened to mortgage rates since the change as well. And then I just thought I'd plug the fact that, we've got CPI inflation data coming out for Q2 next Tuesday, so just over a week ago. But yeah, I don't know, Kelvin, do you want to just wrap up your thoughts in terms of anything else that jumped to mind, anything else you read that you think it's worth talking about, potentially around the peace deal, where we're likely to get to by the end of the year for the official cash rate, and any roundup of what mortgage rates did in the hours or days following the decision itself?
Yeah, I think with mortgage rates, I'm not sort of studying them all day, every day or anything, but from what I've been reading, I mean, pretty much floating rates went up across the board. I don't know if they went up by the full 25 or maybe a little bit less or maybe a little bit more, don't know. But I think pretty much floating rates went up as you'd expect. That's where floating rates are funded from, that short end. And I don't know if I've seen any longer term fixed rates go up, or at least not publicly announced by the banks. So, maybe they've reduced the discounting behind the scenes. You're never quite sure, but at least in terms of publicly announced changes, I don't think any fixed rates have really shifted. So it probably went exactly as you'd anticipate. A lot of this was already priced in, so fixed rates don't necessarily need to change. But at that shorter end, the floating end, there was a bit of move there. So probably no great surprises there. I mean, yeah, in terms of that next big indicator, CPI data out for Q2 next Tuesday, that'll be a biggie to watch. I think from the latest monetary policy review, they were going for 3.9%. Is that right, from their sort of revised forecast? So I guess if we see a 3.9% figure for inflation in Q2, it's sort of neither here nor there. Doesn't change too much, but you definitely get a bit more concerned if it was well above 3.9%, and obviously if it was well below, you take a bit of reassurance from that. So it's probably the magic number there is 3.9. We'll get the monthly selected prices and indices from Stats New Zealand this Friday, so that'll be a wee bit of a preemptor for that CPI. That'll be the last, so that'll be the June selected price indices numbers. So that'll, part of that at least will be feeding into the Q2 CPI. So that'll be a biggie to watch this Friday. Again, if it's surprisingly high, you'd perhaps start to have some doubt about that 3.9% CPI number. But on the flip side, a lower than expected indicator on Friday would obviously be a good thing. So yeah, a couple of things to watch around there. I don't know. I mean, I don't have too many extra thoughts around the OCR, the sort of what came out last week. I think probably, given one of their key motivations was really just to get going. They said even before the Iran conflict, we need to raise the official cash rate anyway. We think the economic recovery will probably be strong enough. We need to sort of keep inflation under control. We're still in accommodative territory, so at some point they were always going to be raising the official cash rate anyway. So this latest decision probably was a case of, well, we had to raise it anyway. Let's get on with it. Probably, and also a lot of committee members noted there that they still had concerns about medium-term inflation. Even when we thought the peace deal was lasting, they had concerns about that medium-term inflation. Now that we're back on shaky ground again, I think it probably just reinforces what they said, is that OCR is going to have to go up at some point. We've already got on with it. Probably actually in hindsight makes it sort of a nice preemptive move, or they looked into the crystal ball and got it right. Not that they knew that at the time, but yeah, it sort of just backs up what they said, really. We've now got even more uncertainty, probably, if anything, a risk of more inflation than what we thought. So yeah, provided that economic recovery is pretty stable, which let's hope it is. I think it probably just reinforces what they did, and the longer the uncertainty lasts, the more inflation we're going to have. So the more the need for those official cash rate increases to keep coming through, like they talked about. So yeah, I think probably even last week before the Iran situation kicked off again, we were probably looking at another couple of official cash rate increases this year. If anything, the last few days probably reinforces that. So there's 3 more opportunities. They've got a meeting in September, one in October, and one in December. So 3 meetings, maybe 2 official cash rate increases. Doesn't necessarily have to be one in September, I suppose, but it is a monetary policy statement month, so there would be the chance to revise their forecast, give a full discussion of what's going on. And so yeah, I haven't fully thought about it, but I guess there's a fair chance of another official cash rate increase in September, particularly given if this Iran situation lingers the way it is now, and then maybe one more in either October or December, just depending on how the data comes in. But yeah, kind of where I sit at the moment.
Yeah, no, fair enough. And I think, yeah, like you say, maybe a bit of credit where it's due, that, yeah, if you were going to err on the side of caution, and part of it was, will this peace deal hold? And you thought, well, if there's any chance it doesn't, inflation's going to be worse. So like I said, get ahead of it, then fair play. I suppose the only potential other side to that I'd propose is that I still think the economic data is not quite as strong as they think. I'm not sure I'm as confident in the economic forecasts and recovery as they are, let alone what's happening now. So, I think that's where my skepticism comes in. But yeah, for sure, in terms of potential upside risk to inflation, which is what those couple of committee members referenced for why they were so strong on the increase. Well, the other said it was more balanced, but they still agreed with the increase to get ahead of it. I don't necessarily disagree with that potential for higher inflation, but the economic growth I think is probably going to be worse than they think. So again, we won't know until we keep getting that data, looking at all the releases we get as soon as possible, and then we just wait and see what they do on the next couple. But yeah, I tend to agree that September's probably lining up for another increase, but maybe only one more after that. So yeah, but we will wait and see. That 3%, obviously by the end of the year, seems to be where most people think will be. Potential for 3.25 if we get 3 out of 3. I don't think anyone's expecting a 50 basis point hike at any stage, but again, the data might determine whether that happens or not. And then, of course, we had that conversation last week, which I do suggest listening to our response from the decision last Wednesday, about whether that neutral interest rate is a little bit higher than we previously thought. And again, how we know that, I'm not too sure, but it'll certainly be interesting to see where we get to at the end of whatever the cycle looks like, maybe late this year, into next year anyway. All good, mate. Well, that will do us for the roundup of things from the last week or so. This week, we actually talked about last week, the CCCI, the Construction Cost Index, was going to go out last week, but there was quite a bit on, so we've delayed that to this week. So that'll be out this week, so keep an eye out for that one. I'm filming the monthly video on Wednesday, so that'll be available later in the week as well. So, I spoke earlier about having those visuals, those who got the nice visuals alongside things, and I put a few references to buy classification in there, of course, so keep an eye out for that one later in the week. But otherwise, mate, that'll pretty much do us for property and economic chat today. Anything else on your mind before we do a bit of a personal roundup?
I think that's it. Yeah, always plenty to chat about.
Yeah, of course, mate. Yeah, we could go on forever, but let's go there then. But for everyone else that doesn't want to hear, mostly a sport chat, I suppose this is going to lean into. We will catch you all next week. But yeah, Kelvin, I don't know how much of the All Blacks test you watched. Nice to have it early in the day. So that was really family friendly. It was sold out. So I'm glad that Wellington stepped up there. But I have to say that, myself and my son Fergus went along, and the game itself was probably a little underwhelming, particularly that first half. Very stop-startish. Skill level seems to be down. Ref probably wasn't great, if we're honest. Things got better in the second half. And obviously great to see Will Jordan get the new record for the most test tries for the All Blacks ever. So yes, a few good things there, but certainly plenty of frustrating things as well. Your take watching it on TV, mate?
Yeah, pretty similar. Yeah, it was. It feels like they got to the right decisions in the end, but it took some weird roundabout ways of doing it. I'm not sure I've ever seen anybody yellow carded come straight back on. Like it's probably the right decision, but we got there in some strange ways, and apart from that burst of tries, sort of just after half time, it was pretty middling the rest of it. So step up for Ireland at Eden Park. I'm not sure the Irish are that convincing against Japan, but they're going to lift at Eden Park against the All Blacks, given the recent rivalry. Should be a biggie. Will Jordan, 50 tries. I hope he carries on and gets to the world record. It always felt like an All Black should have that record. So that'd be good if he can get there. He seems to just pop up in the right place at the right time, doesn't he? He's got that ability, and obviously quite quick as well. So that always helps. It was good. Family friendly time, and so all good. My daughter definitely loves the haka at the start. She sort of fades off through the game, but definitely loves that sort of entertainment at the start. So that was cool. Look forward to the Irish game, and then the big tour after that.
Incredible. Yeah. And I happen to report the weather was great as well. Maybe part of my frustration with the game is that, we happened to miss a few of those early tries in the second half, just away getting food and drink and going to the toilet and things after we actually stuck around in our seats for the halftime show. So they're putting on decent halftime shows at these events now, but it means you stay there and don't get your drinks then. So we ended up missing the start of the second half, and I didn't think we'd miss too much given the way the first half went, but clearly, the All Blacks came out firing, and I happened to watch the game when I got home as well. So I have seen them all, but just not live in person. So a touch frustrating on that one, but it is what it is, and just glad we had a sellout, good crowd, great time at the kickoff, good weather, and let's hope that that they can bring it all together, because there's been certainly some good signs from the last 2 weeks, and get a great test this weekend up in Auckland there. So you're looking forward to that one. Can't avoid the World Cup at the moment, though, mate, the Football World Cup. So, semi-finals, of course, coming up this week. I thought, pretty impressive to see the top 4 sides actually get there. The top 4 ranked sides make it to the semi-finals. And there's a little bit of me that's a little bit disappointed we haven't had an underdog go on a bit of a run. They can kind of light up the cup when they do that, and we haven't had that this time around. Obviously, some teams getting to the quarterfinals, Norway's first ever, Morocco backing up after a strong World Cup last time. Some good stories in there. But not to not make it through to the semis is probably a little bit sad. But I think there's no doubting we've got the best 4 teams to this point. And so going to be some cracker semi-finals and a final to boot, no matter who makes it through. So, watched the English game yesterday at a mate's house who was English. Certainly lots of passion to watch that one, but it was good value, mate. Otherwise, mate, anything else on your, mate? How was the Matariki weekend, long weekend, I suppose, but it's in the middle of school holidays, so kind of doesn't feel the same as maybe a normal long weekend does when the kids are at school, but you're surviving that. Any other thoughts on sport or how your weekend went?
Yeah, pretty much surviving. I mean, these holidays have felt longer than normal. I mean, we had a whole week pretty much of rain, which didn't help. Better seems like it's going to be better this week, so that is definitely a huge bonus. But getting through holidays, I mean, the long weekend sort of came and went a little bit because it's it's in the middle of holidays, so you kind of it's not a huge shift, but that was good. And I mean, the football for me, the England Argentina, like that's, I lived in England for a long time, and I know the history of those countries have obviously had a wee bit of conflict over time on a sporting pitch, obviously at the World Cup, and the odd war thrown in there here and there as well. So that's a biggie for me. And one of our neighbours is English, so he's right into it as well. So that'll be the one for me to definitely keep an eye on. And who knows? Maybe England could they win the World Cup? It'd be I think it's 60 years, isn't it? 1966, the last time they won it. So that'll be the game I'm watching for sure.
Yeah, no, it's huge. There's no doubt about it. And let's hope no bad controversy. Like, you can have some crazy moments and whatnot, and that's okay, but nothing that defines the game. And we, get a genuinely good, openish game. I think both teams have shown, keenness to go forward and score goals. The other game might be a little bit more tighter because Spain don't concede too often. But that game should be entertaining, I think, at the very least. And let's hope that controversy isn't the biggest thing going on, because there's certainly been a bit of it throughout some of these games. But no, that's all good, mate. Looking forward to it. And I think on my mind, actually, in terms of the Matariki weekend, had a visit to the sort of Wellington waterfront festival here, Matariki Ahika, which was the sort of festival that goes on every year in Wellington, around the waterfront. All the food trucks are out, of course, and we had some good weather again yesterday, which is when we went and visited it. It's over the whole weekend. Lots of cool displays and projections on like Te Papa and stuff, with cool Māori stories. Cool, just good stories and interactive stuff as well for the kids, and lots of fires around too, obviously representing the Māori New Year. So always a really good event and well attended. So I'm obviously hugely biased, but happy to attend that Wellington's embraced all of those events, and we're certainly, Wellington's not dead just yet. Good times, mate. And as I said, helped out by when the weather comes right, because we had a few tough days weather-wise last week, but it's come good last few days, and same thing again today. So not all bad here in Welly, let's say that much. But that'll pretty much do us, mate. Anything else on your mind before I close us out?
That's it. Yeah, watching that, keeping an eye on that England Argentina. Maradona would struggle to sneak through the hand of God now, wouldn't he, with video refs and stuff? So
yes, indeed.
Definitely keep an eye on that.
Awesome, mate. I'm looking forward to it. But thanks as per usual for your thoughts and insights, Kelvin. Always appreciate it. Also, thanks very much for listening. Please do get in touch with any questions or feedback. Keen to hear your thoughts on what's going on with that lending side of things, maybe for those investors. So please do get in touch with us. But that'll do us for today. My name is Nick. He's Kelvin. You've been listening to New Zealand Property Market Podcast. Mā te wā.